this thing. Okay. 5, 4, 3, 2, 1. Welcome to the Daily Energy Markets Podcast. It is September 14th, Wednesday, middle of the week. We have oil markets a little bit off, but nothing dramatic. It seems to be holding the gains that were captured at the end of last week. But with Brent firmly above $92 a barrel, WTI still below the 90 level. The spread between the two does seem to have grown, but nonetheless, it would seem the oil markets were fairly nonchalant about the big shock news yesterday, which saw, of course, a surprise on the core inflation in the United States, which has now signaled a trigger for a more robust tightening cycle. At least that's the expectation now. Let's welcome and start. We'll go all the way around the world because we're literally all the way around the world today, from Australia to Florida and Italy in between, and of course Dubai. So I think we're literally circling the globe this morning. But we'll start with Peter McGuire, CEO of XM Australia, looking out on Bondi Beach. Peter.
Well, good morning. Good morning, Sean. I'm actually Coogee Beach.
Coogee Beach. Sorry.
Greetings to everyone. Yeah, I was up late and I just watched it. I mean, it was an ouch of a night. It was spanked down the NASDAQ, as we know, down over 5%. And it just took everyone, I think, by a little bit of surprise. The energy markets, as you said, they were positive there for a while. They whipsawed a little bit, but King Dollar reigned supreme. And the market, I'm just noticing now, just across the blast here, at 9.9% for UK inflation. So, you know, it's high. How do we manage it? They're going to ratchet it up. Are we 75 basis points or 100 basis points? Everyone's scratching their heads a little bit. And Australia was down 2.6% today. Asia was washed out, and equity markets are under the pump, Sean.
Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, you've been a fairly strong bear on this program for a while. Your thoughts on the aftermath of the news yesterday? Seemed the oil market sort of spit it out, didn't pay too much attention.
They didn't, but copper sure did. Copper was up almost 2%, 1% before the print, and ended up down 1%. And I think that's where oil's going to follow. Copper's down 20% in the year. It's all the industrial metals are showing the global economic strain, which I fully expect we're heading to a global economic recession. And what better recipe this year than the war and the aftermath of the biggest pump in liquidity ever that's being dumped? And you've mentioned the Federal Reserve is tightening, but the rest of the central banks of the world, with the exception of China, are catching up. And as Peter mentioned, King Dollar. I mean, this is a complete lose-lose recipe for commodities. You have the world's largest energy producer, net exporter, world's largest agriculture exporter and producer, and the country with the world's strongest currency, raising rates aggressively, tilting their economy to a recession. Europe's already in it. China's faking the numbers, probably, or having issues. And to me, it's just a classic recipe for what we happened in 2008. It just is going to be more enduring. So I fully expect crude oil to reach the ceiling around 100, and it's going to head towards initially unchanged in around 75. And I'm talking WTI. My question I asked for myself is, what stops this? It's certainly not going to be the Fed.
Well, let's go to Reem Shamsuddin, a journalist based out of northern Italy, formerly the longest-serving Reuters energy correspondent in Saudi Arabia. I think you still have that title, Reem. I'm not sure. Maybe somebody has knocked you off the pedestal, but nonetheless, spent a significant amount of time in Saudi Arabia. Reem, how strong do you think the kingdom is going to try and defend this price? Because as Mike asked, what can stop this gravity? Well, Saudi Arabia cutting 1 million barrels a day, perhaps. Your thoughts on where Saudi stands on strategy now?
Morning, Sean. Good morning, everyone. As the Saudis have always said, they don't defend prices, a price range. Never officially have they went out and spoke about defending a price range, rather than all the time reassuring the markets, trying to say that we are here for the markets to be more stable. And this is what they've always said, and this is, I think, the official line that they've always believed in doing. Now, the monthly report of OPEC was out yesterday, and it showed that Saudi Arabia has actually increased its output to a little bit more than 11.05 million barrels per day in August. And so this is, they've a little bit increased their output for August. And we know that Saudi Arabia has the capacity to boost output to 12 million barrels per day and sustain it. They've tested this in the past, and they were able to sustain it for a few weeks. So yes, it's not about defending a price range at this time. It's about reducing the volatility that is in the market. Prices have been volatile, and I think this is like what is really the number one concern for OPEC and for Saudi.
Interesting. Peter, one of the ramifications of yesterday's news was also the return, not the return that it was gone for very long, but nonetheless, the sort of mighty climb of the US dollar was back in front and center, and particularly as we continue to cover its impact, particularly versus the yen in your corner of the world, but the dollar back very strong. What's the ramifications for that, do you think?
Well, Sean, I mean, here we are, 109.80. That US dollar is 110 or 111. Traders are saying to me, we thought that 145 was going to be the line in the sand for the yen. Well, I tell you what, it's just as well, it's touched it or nearly close to it. So as the new number, this is what traders are saying, is 150 the new handle for the yen. I mean, 150, what it's done this year is just mind-blowing. A 112 to 110 handle for the pound, and 96 to 97.5 for the euro, because everyone just says that we're onward and upward for the Fed to charge rates. They've got that inflation number. Their mantra just seems to be just, ratchet it up, Sean. So the issue is going to be, and the impact is naturally to the countries like Japan, their currencies being created, and the cost of energy is just going through the roof. So it's going to be a double whammy for them. And maybe we're at a 112 by October, mid-October to end of October. That's a very, very strong number, Sean, US dollar index.
Oh, and Peter, from your own analysis, why do you think the Bank of Japan are not intervening? They have been quite interventionist in the past. On this occasion, they're basically absent.
Well, they're certainly sitting on their hands, and I mean, you could write.
Their hands are chopped off at this stage, I would think.
Well, yeah, maybe the Yakuza have got
sitting on their hands 30 yen ago, maybe.
That's right. Well, they just doesn't. I mean, you could write a thesis on it, as far as what the BOJ's thoughts are. We're going to see inflation start to ratchet up strongly if it can in Japan. Aging workforce, you're talking about, they're still locked down to some extent from travelers and tourism dollars. So all of that, they've got to open up their doors, and they've got to get hard currency in there. You've got to turn Japan into the travel destination that it deserves to be, and it used to be. And they need to take on board hard currency. They need to look at where their yen is going. And maybe that's their master strategy, to weaken the yen and make, all their exports more competitive.
The situation in the US, Mike, is a little bit obviously the sort of story of two cities, if you like, in the sense that the economic macro numbers remain very strong. And the Fed now forced into a more accelerated press on the brakes. Could the economic performance continue to deny the impact of the Fed? I mean, interest rates aren't what they used to be.
I think the trajectory we're heading for in the U.S. is a recession. And the key thing that's really more significant is that there needs to be a decline in risk asset prices much more than we have already, which is potentially the stock market. Because the way I see it, the only thing that's really going to stop the Fed more real time is if and when the stock market goes down at a higher velocity. Now it started to return to that yesterday, down 15% in the air for the S&P 500, almost 15, almost 20%. S&P 500 is just not enough. I think it's got to be down at least a third, if not more. That will slow down the Fed tightening. And that's the key thing we need to do to reduce this inflation situation. That's kind of like the market taunting the Fed lately. We have not dropped asset prices enough to reduce the ability for people to buy stuff, which is what Jim Bianco says, my friend out of Chicago. And I think that's what's going to happen. That's what needs to happen. Even Neil Kashkari of the Fed Minnesota Bank said that. So to me, it's just a matter of time. It's the time of year for that to happen. Yesterday, people got the realization. And I think all equity rallies will be sold. I think the same thing in most commodities. And the key question I ask is what stops this? The number one thing we need to do is this is part of that reset. And I go back to the macro on this. When you have something this significant, which I think we're going to look back from the future and say that's what's significant, you have to go back to the key rules of economics. Number one, it's inflation is always monetary phenomenon from Milton Friedman. And now we had the biggest pump in liquidity ever last year. Now it's dumping at the greatest pace ever. And then it's also that invisible hand of Adam Smith. And to me, that's what's showing up in demand destruction, elasticity of supply and commodities. And it's just normal. What's abnormal is to sustain commodity prices at the levels they were just 6 months ago. What's normal is to dump like we did in 2008. And I fully expect that to happen. I think it's just getting started.
Maybe Joe Biden and his team should have been targeting something other than lower gasoline prices, because that obviously hasn't really shifted the dial. It seems it's all about higher rents that everybody's paying that is keeping the inflation levels up.
Well, the housing market's turned, but it's much more of a lag than the real-time stock market. And that's just, there's offers that has become a buyer's market. So rents are just more of a lag. And that's the key thing. We're watching inflation, which is a measure of the last 12 months. And we're only using 12 months. Now you use 120 months, it's no problem. It's not a big deal. Let's look at the price of crude oil right now. On the screen, 86 bucks. That was first traded in 2007. Just imagine if we said that about the stock market. So people need to, that was the thing I was pointing out about commodities. They just don't have this ability to go up like they used to, particularly in an environment where the Fed's tightening, the dollar strong and China's weak. That's just a lose-lose for commodities. So my point is, I don't know what's going to change it. And I thought we got to get through this reset period. And I think that's all we're in right now. We're in that, the pendulum has just started to swing lower, is what I think. It's early days. And what stops it? That's the question I ask everybody. I don't see what stops it. I just think of where's the floor? And copper's a guide right now. And I think the floors are lower for crude.
Well, maybe Reem might say oil is dirt cheap, because you should see the price I'm paying for gas to turn on my cooker. It's crazy in northern Italy. Reem, you have a big election coming up in Italy. It could sort of be a defining factor for the impact of European unity in terms of you have a strong right wing possible success there. We looks like the strong right have taken the win in Sweden. What's your outlook for the Italian election result and the consequence of that on policy for European unity?
Yes, that's a difficult question.
No easy ones this morning, I'm afraid.
Yes. Well, based on what what I can see and what I can understand from the Italian, media, so it looks like, yes, what you're saying is correct. Like, it looks like during the election which is happening in September 25. So it looks like, yes, the ball is tilting a little bit to the right side. Yes. So what impact on the unity of Europe? I mean, we've always seen like new governments and new people coming, but it's at the end of the day, it's democracy. It's what people decide. So it's a reflection of what people want.
Well, we've seen in the past, like Berlusconi being very friendly with Putin, and Berlusconi's party is part of that right-wing coalition that's going to win this election. What does that mean for Italy's position vis-a-vis tightening or maintaining the line of sanctions against Russia? We'll have to see. But Is there any sense of that in the press that to ease back from Russia?
I haven't seen this much in the Italian press. So I really can't say.
Well, it's certainly something we all have to watch, because I think it is potentially the big. Sweden might be the cooker in the coal mine if indeed the right wing take it in the next few days. I think the final result comes tomorrow. Peter, speaking of major geopolitical positions, we've got the president of China and the president of Russia meeting, arriving in Central Asia for the Shanghai Forum. First meeting since before the invasion. What do you think is the impact, the sort of optics of that from the posture of an Australia or from the Western Alliance point of view? Where do you think China goes with this relationship?
Well, we're looking very closely from an Australian viewpoint, Sean, naturally, because we're right in that corridor. So maybe our lens is a little tilted, different to how the West is viewing it. But from an Aussie perspective, we're worried about what's happening as far as the strength of that Chinese economy, our exports, and the overall themes, the joining of the hip between the Russians and the Chinese, how that moves forward, both geopolitically and economically. Now,
I mean, one of the sidebars on that story is the Chinese getting a further footprint into some of those Polynesian island states not too far away from you, which were previously sort of safe harbor for Western naval vessels, including Australian, who have recently been told to get out of our waters.
Well, that's right. The likes of New Guinea, the Solomon Islands, you're thinking what happens as far as Fiji, run yourself, as you mentioned, across that Polynesian basin. That really creates a lot of angst for both from a defense standpoint and from, I think, a Belt and Road initiative. This may not be Belt and Road. It may be even more influential than that, and the impact that can have to someone like Australia. So yes, it's a changing of the tide. There's some major impacts, I think, across the next decade, and how we manage those, and both with a new government in Australia and what their overall theme is towards China. And we're so reliant on them from an export side. So yes, Sean, we've got our eyes on the board and just taking it and inhaling the rhetoric that comes out of it, and the viewing of what the situation presents both to markets and to overall economy across Asia.
I haven't quite worked it out yet in my head, but a part of me is starting to think that the deep state of American politics, geopolitics, wants to force China into a closer relationship with Russia and sort of get into the chaos of Putin. And what does the chaos of Putin bring to the stable, nice, calm universe that the Chinese love? I think that's an interesting dynamic that still has to play out. We won't get into it now. We'll think a little bit about it. But Mike, meanwhile, back at the ranch, literally in Montana and all those lovely places, the railway are going on strike. How big a deal is this story that seems to be bubbling more and more up to the surface? A major rail strike across America that even is bringing headlines of threatens the economy. A lot of things move across rail in the US.
Yes, that's one issue that's harder to, I look at it more the macro, and I think you touched on it very well, Sean. It's just not good for the economy, which is very strong right now, but I think it's on the edge of tilting lower. It doesn't really, I think, affect asset prices too much because it doesn't really, it's not supply and demand, but it's the macro that matters. And to me, that's what, unfortunately, the Federal Reserve needs. They're going to raise 75 basis points next week. Remember, a year ago, we thought they would go, that would take 3 meetings. That's just one meeting. And to me, this is the sledgehammer coming down hard. And I fully expect something's going to break. Now, we mentioned the dollar. The dollar is showing other economies that are breaking hard. Is the yen down almost 20%? the Chinese yuan's down almost 10% this year. That's not going to stop until the Fed stops, until asset prices go down enough to stop them. And that's where I think rails, that's just part of the whole scenario. And to me, it's the macro that matters. And this is quite significant, and particularly because I think here's a quote, I don't think we've ever had a period in history of mankind we've had this many central banks all hiking rates at the same time. So it's the macro, it's global. And it's, to me, it's a question of where does it stop and where do markets find bottoms? I think they're much lower than they are now.
Well, let's go to the survey question and give the room a chance to vote on some of this stuff. How will oil markets react to a more robust Fed tightening cycle? As Mike just said there, what was meant to be maybe over 3 Fed meetings, we're now getting boom, boom, 75 basis points. And even last night, reporting, although minimal guidance, that there could be a 1%, 100 basis points. But clearly we're in a tighter, more robust Fed tightening for longer. A lot of people were calling this rate hike the last of the big ones. Now that seems unlikely. So my question is, how will oil markets react? As we talked about earlier, seemed a little bit nonchalant about it yesterday, but as time moves on, how will oil markets react to a more robust Fed tightening cycle? Will it rise? Will it fall? I mean, destroys demand, pushes economies into recession. Will it be somewhat neutral as it was yesterday? We will have to see. Reem, you talked a little bit earlier about Saudi Arabia don't change the market in order to manage price, and I won't argue that point with you, which I think is completely wrong. But nonetheless, the question of the idea of managing for stability, for market balance, for these types of things. We've seen Saudi willing on the lower end of this cycle, when prices collapsed, they were willing to take a greater burden on them by themselves when they cut an extra 1 million barrels a day. I'm wondering on your thoughts moving forward as we move into maybe a requirement to balance the market under these extreme sort of outlooks that we're seeing now forecast. Do you think there is still an appetite in Riyadh in Saudi Arabia to make or to carry extra weight of this correction when it comes? I think the prince has said that all the cards are on the table. Everything. I mean, anything can happen at this stage. But yes. So the options are open. But for now, I think it's too early to discuss what will happen next. Even though in the last meeting, in the Opec statement, they said that the chairman can convene or can call for an extraordinary meeting if the need is there. So for now, I think it's too early to discuss what will happen. But as the prince said, that the cut can take many forms. What is your thought then, coming at this sort of story from a slightly different angle? The Saudi 2030 vision, did we lose Reem there? Maybe somebody interjected on her.
Yes,
Reem,
yes.
you're there. Sorry,
I'm there.
I
Yes,
lost you.
I'm
Yeah.
Yes, I'm there.
You
I'm
put
there.
on your chador. The question I was going to ask you was, how does the Saudi Arabia Vision 2030 and all of its significant expenditure around building such magnificent ideas like NEOM circle with a lower oil price cycle, if indeed, according to Mike, we're going there? How does that vision coexist with a lower price cycle like we had in the years before going into COVID, where we had an average more 50 to 60 than 80 to 100?
Okay, we're talking here about the capital expenditure of.
Yeah, I'm trying to get at the issue of Saudi Arabia has a lot to defend now that they didn't have before.
Yeah.
And hence the requirement for elevated oil revenues. You're arguing that they don't have a target for elevated oil revenues.
Yes.
They have a target for balanced market.
Yes.
I don't know if that's the same thing, but ultimately, I'm saying to you that now Saudi has a very serious vision in place that they didn't have before, that requires bionic revenue, not just average revenue. And I want to get your sense of how much they're willing to either compromise the vision or compromise on price.
Well, the budget is based on different ranges. It's not just about one. I think they take all the time conservative, pretty conservative budget projections about the oil prices. So, and they're trying to diversify. So I'm not so sure. The numbers are not in my head now to see how much they're still reliant on oil or not. I think they're pretty much still reliant on oil, but I think what I want to say is that the budget is based on different ranges, and I think that they can adapt to a different scenario. I'm sure that they've taken into consideration different scenarios, whether the oil price is going to drop, and I'm sure they have their own calculations about and views about what they should prioritize in terms of projects. We've seen in the past, these happen all the time, not just in Saudi, everywhere in the world. When there's a project that probably at a certain point it's economic, at a different time it's not economic, and they revise all the time the project. So it's about the long term, prioritizing what needs to be done and when, and if it's economic or not, if it's viable or not.
Okay, Peter, speaking of viable and a very critical part of the Saudi and OPEC plus outlook, and for all of us perhaps, is as you articulated earlier, where does China go? Where does China demand go? And as also Mike referenced, China is in a very difficult place in terms of its economic performance. There was an expectation, there is a certain expectation that once the Communist Party conference is completed in mid-October, that we'll start to get a backing away from the zero COVID policy. We'll start to get a sort of a China we're all familiar with. Your thoughts on the likelihood of that happening?
Well, I think domestically, the population would love that. They'll be rubbing their hands with glee, Sean, if that's the situation. The second part of it, of course, is we've got not only a slowdown, but a very, very worrying property market. And that's creating a lot of angst, both internationally with international banks and with all forms of debt holders across their property market. So that's another major impact to the market that we're all looking at and all absorbing and realizing that is October when we see the end of the meeting and the strategy and everything moving forward. This is what's going to be presented to the market. Yes, we've had the lockdown start to be eased, but is the property market going to be the number one concern, economic growth, and how China manages those expectations?
Let's get this survey result and give Mike the last word here this morning. Neutral seems to be winning out at the moment. We'll post that on Twitter and see where the Twitterites go with it, but neutral at the moment. Mike, just wrapping up your thoughts, the US outlook for new production, and again, another factor that could be contrary to your sort of outlook, in the sense of that oil production in the US seems to be not growing at the very least. We're seeing a report out of Bloomberg yesterday, out of your own colleague Javier Blah, who says, I love the headline, Houston, we have a problem. We have an oil problem, where rigs in the Permian are declining for the fourth month in a row, as oil prices have hovered near $100 a barrel. Square the circle for me on that and the outlook for that and its relevance.
That's noise. it's the macro invisible hand that matters. Net U.S. imports, which is now negative. It used to be imports of liquid fuels. As of next year, will probably be 2 million barrels a day. That does not include Canada. The deficit of production over consumption, if you include Canada, of liquid fuels is approaching 20% next year, unless prices drop. Remember, you have to include things like biofuels in there. Now, liquid crude oil is the biggest part of it, but yes, they've been a little reluctant to bring on supply. But one thing that's factual is there's very little correlation between rig counts and supply anymore because of fracking and horizontal drilling. At least it's something I wrote about months ago, years ago. So it's just that invisible hand we should stop trying to ignore. That is, when you profit, people who own land can make a lot of money. I'm a former landowner. You're seeing it in corn, soybeans, and you're going to see it in South America. You're going to see it in the world's largest crude oil producer, the U.S. Just a matter of time. But the more significant part is
the underpinning, though, Mike, to interrupt you, just to get this in that the commitment by the majors and the smaller producers seems to be give more money back to the shareholders because they've been beaten up by that for the decade before. That trend seems to be fairly locked in, and if it is, we're not going to be getting too much new supply out of the US.
Beware of widely noted narratives in commodities that don't make economic sense. That's just, I remember peak crude. We all remember that from 10 years ago. It was completely wrong. What happened was peak consumption in the U.S. Consumption in the U.S. is flat and declining. That's just a fact of what's happening. So I point out again, why then when people say that, that's good luck with that one, because you're saying that anybody who owns land is not going to make that money. Remember, there's hundreds of independent oil companies in the U.S., and they have the ability to make money. They have the ability to sell on the forward curve out a year from now and still double their cost of production. Yes, everything's going up in the cost of production, but if you have the average cost of crude oil production on the Bloomberg terminal, the data we show is right now it's below $50 a barrel. The data goes back to 2014, and then it was $70. It's declining. You can create more of it. And then there's things like natural gas. There's an ocean of natural gas on the state of New York. The average cost of production in the U.S. is $2. On the screen, you see 8. We've had a problem. Why is this price of natural gas the same as it was almost 15 years ago? Because the supply can come on, you increase the technology, and then it's also squashing both sides of it. That's for a big picture. I'm bullish on metals. I agree with Jeff Curry there, but I point out in crude oil, it's one of the most elastic commodities, and it's basically a cycle, and it typically is a pump and dump commodity, and that's just pointing out facts, and now it's dumping.
Well, one of my favorite data points of the year is that the University of Texas is now wealthier endowment than Harvard because they're one of the biggest landowners in the Permian Basin, and so are making a fortune this year. And so they pipped above Harvard on the endowment. I thought that was kind of funny, not funny, but somewhat insightful in its little data-ness. Thank you so much, Peter McGuire from Australia around the world. Mike McGlone in Florida, Reem Shamsuddin sitting in beautiful northern Italy. No more nicer place this time of year, you'd have to say. All the best, and get out and vote, Reem, next week. It's important. We'll be relying on you to swing it the other way. All the best, everybody. Every morning, 10:30 UAE time. Thank you.
Cheers, Mike. Thank you, Sean. Bye, Reem.
Cheers, Peter. Cheers, Reem.